There's cash on cash return. There's cash flow to your bottom line. There's return on equity. There's lots of metrics and ways to look at your finances. And I don't think I know right now what the right decision is, because it's not time to make that decision. So a year, 2 years from now, if it stabilizes, time to consider refinancing or making an exit. You kind of look at your personal situation and decide what's right for you.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else. With your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How's it going, bud?
We're good. We had some major developments happen yesterday, so it was quite an entertaining Monday, to say the least. But I think we're better off today than we were yesterday. I'm excited for what's going to happen.
Yeah, no, it's been good. It's also been a good timing week because we're doing all our quarterly updates for all our deals too. So we chose a good week to kind of put everything together.
That's for sure, because in the quarterly updates, we will obviously make the announcement, and it's exciting. There was obviously a part of what of what happened that was not the best, but at the end of the day, I think we're making the right decision, which is going to be amazing. Yeah, so we're not trying to be overly cagey, but maybe next week's recordings we'll talk about it a bit more. But with that being said, let's jump into today's episode. We got a really great guest on today. Somebody I've gotten to know very well over the past few months, and excited to have on one of his first podcast episodes. So be nice to him when you hear him. But I think he's going to have a really interesting story, really interesting perspective that a lot of people will relate to and understand, and maybe have a different take on real estate and the investing journey. So with that being said, Ryan, thanks for joining us, bud.
Yeah, no problem. Thanks for having me. How are y'all doing today?
Yeah, doing good. Happy to have you on. Why don't you kick us off? A few minutes, just you, where you're from, your background, journey, and what you're doing.
Yeah, so I am an ex-tech person, right? So I spent 20 years in the software industry. I have a computer science degree. I was a software engineer right out of college. And, for the next 20 years, I was in software engineering. I was in tech, doing engineering management and leadership at the end. My last role was a CTO of a startup here in the Durham area. So I'm based out of Raleigh-Durham in North Carolina. And about a couple of years ago, I had a chance to take a step back and kind of look at, my financial success, or maybe lack thereof, right? My net worth. And despite having done everything right for 20 years, saving in 401ks and the matching and the IRAs and the stock market, all the index funds, all the things you're supposed to do, I looked at how far that had gotten me. And after 20 years of doing everything right, it just felt like, man, something's missing here. I'm just not as far along as I would have hoped. So that was kind of the impetus for me to start looking around at what other options there were, and which drew me to real estate. And then over the next couple of years, I kind of did your typical real estate journey, which is, step one, get engrossed in biggerpockets.com and single family rentals and the BRRRR style. And I did the BRRRR style, purchase and renovate and rehab and refinance and rent and whatever the 27 R's after that means. And I did that successfully in Kansas City, which is a good cash flow market. I still have that property today. It's doing really well, but it also only got me $200 a month in cash flow. And that certainly is not gonna cut it. And doing that 100 times over was also going to be a huge amount of work, right? So as many people do, got disenchanted by the lack of scale in that process, and then turned to multifamily, did some more research there, and have been really heads down on multifamily for a while now, investing both as an LP and now recently being on the operator side and kind of making this my new profession. So I left my job in January of this year, my CTO job, and had some savings saved up and wanted to kind of spend this year seeing how far I could go on the real estate front, and now have about 80 units under active management and really hoping to continue that growth into the next year as well.
Love it. You chose a really good year to quit your job, right?
I can't tell if that was a lucky on my part to not be dependent on a job or if it was terrible timing. I kind of come down in between. It's definitely a little harder maybe to get some real estate things done and to go view properties and do this and that. But also maybe there's opportunity here, right? Maybe some people move to the sidelines and it creates space for somebody like me to be able to step up and stay active and get something done. And, I just closed on a 50 unit last month that, we put it under contract in July, and through the closing process was really the dead of COVID, when all this stuff was happening. So it's still possible to get stuff done out there.
Yeah, 100%. So I want to back up a little bit because I think it's interesting. What was it, you're talking about being in the tech world or at that your last job. I'm not sure if it was a job prior to the last one. Was there something that happened that made you start taking a look at the personal finance stuff? Like, was it a conversation or was it just like you woke up and you're just like, I feel like I should have more, like I'm in a, pretty prominent role in a, in a good company. And I just feel like I don't have what I had. Like, what was it exactly?
Yeah, there wasn't a defining moment. I mean, I think when you work so the company was a startup. I joined, I was the third employee. By the time we left, we were around 75 or 80 or so. And so equity was a part of my compensation. And so I think that, you think about finances differently when you're introduced to a new tool for wealth, right? And that was equity for me. And so that just opened up the topic and made me start looking at my net worth as not just what do I have in my IRAs, but then also, I've got this new equity piece. I wonder what that could be someday if things go well. And then when you start doing that, you're like, oh, well, there's this type of an asset. There's my stocks. What else is there? And so it just kind of raised it to the point of consciousness, I guess, to where it's something I started to think about maybe with a little more granularity than I did before.
Mm-hmm. Was it something you were concerned about prior to, and like you just never really spent the time, or was it something you just never really thought about? You're like, I work in tech. I just, I do what everybody else does and just put money away and max out my retirement accounts. Yeah.
So I have always been financially inclined. My parents very early taught me about stock markets and just kind of all the standard equity-based ways of growing wealth. Of course, they grew up in a time where pensions and whatnot were a lot more of a thing. I mean, they both, my dad was in the military, and worked for the state government, so he has 2 pensions. My mom has a pension as well. I mean, they did everything right as far as that playbook goes. Mm-hmm. So I was always very interested in it. So it was never that I wasn't thinking about it. Like every year or so, I'd look at my portfolio, I'd rebalance. I was pretty involved when it comes to that kind of thing. I definitely wasn't financially illiterate. And so I'd always been tracking my progress. But I think, the story is always, you start off small and then it'll build over time. And so in my head, it's like, okay, well, I'm here at X, and that's definitely nowhere close to where I knew I want to be. But this is a long game, and I know I'll get there. But then after 20 years, it's like, okay, well, 20 years feels like a long time. So I should have started to see some of the fruits of that labor. And I just wasn't there. And, when you start digging in, most people think that S&P 500 is 12% a year, 15% a year. Like they think it's solid double-digit returns over reasonable lengths of time. What you find when you start digging in is it's much closer to 6 to 8%. Right? Mm-hmm. Like over 20-year periods, your S&P 500 is giving you 8% returns. When you factor in fees, tax implications, and whatnot, that can really depress that. So when I finally understood that, look, I can't just look at the top line number that my financial advisor says the S&P 500 is doing, which, maybe over the last 5 years, it is at 15%. I had to look over that longer period of time and what the actual returns have been. That's when it was like, oh, okay, I see why I haven't gotten to where I want to be yet. And so then I started looking around.
Mm-hmm. And then what was it for you as you were looking and exploring different options? Because there's a multitude of different things. You could have just decided to invest in other startups, right? That's your world. You could look for other tech software, things that you thought were interesting. What led you to go in the real estate route?
Reliability and consistency and stability, right? So startups, like that's a lottery ticket. You might get lucky, even if you're inside, even if you think you can influence the outcome. So much of it is based on luck and the actions of others and the market, just so many variables that you can't you can't count on for your retirement plan that your 0.1% equity in some startup is going to get you anywhere. So looking at real estate, low downside. If you look at even the Great Recession, especially multifamily, as far as losing assets or going to zero, very, very low risk of that. Yes, rents might have dipped a little bit, but as far as the business of running these properties, they tended to do pretty well and be pretty stable, especially if you weren't doing anything crazy leverage wise. And then over the history of real estate, you just look at the stability of it, the consistency of those returns. And when you take out the volatility, whether it's of startups, whether it's of the stock market, when you take that out, you get really solid, consistent returns. And that was everything I wasn't getting in my traditional approach of investing. And so that's what really drew me to it.
Gotcha. No, I think it's what draws a lot of people to it. I think there's tons of people that obviously want the quick buck, which is why they get pointed towards Bitcoin, Forex, day trading, startup investing, online gambling. But yeah, I think that's what draws a lot of people to real estate is, just a proven model year after year of how people have gotten to a point where they either don't need to work or they feel financially secure or financially free. So I think it makes a lot of sense. Was there a certain metric or target that you were looking to hit that you felt real estate would get you there quicker or more sure? Or like, was it, I know now you've quit and you're doing it full time. Was that the end goal, or was that something that, you kind of fell into?
One of the ways that I reframed my thinking during this period of time was to focus less on, hey, I want to get my net worth to some big number, 3 million, 5 million, whatever, right? It's not about getting that number as high as you can, because the whole point is to be able to live, right? To hopefully live in a way that is comfortable for you, to have freedoms, both in time and lifestyle. And so that's not about net worth, that's about your cash flow. And so really understanding that cash flow is the end goal and not net worth. And there's certainly value in having a high net worth. You all know that real estate tends not to be a game for the poor, right? It certainly helps whether you're getting started or whether you're wanting to establish cash flow to have a higher net worth. So it's not that is bad. But when I reframe the goal to be around cash flow and what I would need per month to live independently, then that became even more clear that real estate was a better fit.
Yeah, I think it's an interesting debate back and forth about like what to shoot for, because you see a lot of people that want to get in and churn and burn and like get in and out of properties quick and build up cash and net worth and then invest and make whatever. And then you see so many people that shoot for, like creative strategies or using other people's money. So you don't have to have a lot to buy these properties, refi out, and then build this cash flow. And I think it's a really interesting debate back and forth, because I go back and forth all the time. Like right now I'm buying this 16 unit with my dad, and I look at it, I'm like, okay, I really think we can refinance out once we're done renovating in 12, 18 months and pull out 85 to 100% of our capital, go into some long-term debt, cash flow $40,000, $50,000 a year with interest only, and probably 30-ish once amortization kicks in. Then I also look at it, we're going to be investing about $600,000-$700,000. And I think, if you sell it in 2 or 3 years, you're basically 2xing your money. And it's like, damn, like, what do? Like, do you hold it and, get money back and, keep it for $50,000 a year? Or do you sell it and turn, 600 into 1.2, even after taxes, 20%, you're talking about 240. So you're left with 900,000, give or take. Do you go reinvest that and try to make whatever? I don't know. It's a really interesting topic going back and forth, and I'm curious how you think about it.
I mean, there's no one right answer, right? It depends on your stage in life, what your priorities are, your goals, what you think you can do with that money. I'm in a similar situation. I have a 12 unit that I own outright. So no investors on that one. And it's not even fully rehabbed. So the plan is to go in, rehab every unit, take rents from average 650 to closer to 800. And, I bought it for around 600K. So it's right at 50K a door. And it's a really solid property, great tenants, great collections. And it's like no hassle for me at all right now. And it's already cash flowing about, I don't know, 2-3K a month. And so it's like, wow, if I look at the equity I'm building up, that could be a meaningful amount of equity. But again, the goal is also cash flow, and it's already cash flowing great. And it's just little engine that could property. So that one would be a tough one to let go, right? But I think, there's cash on cash return, there's cash flow to your bottom line, there's return on equity. There's lots of metrics and ways to look at your finances. And I don't think I know right now what the right decision is, because it's not time to make that decision. So a year, 2 years from now, if it stabilizes, time to consider refinancing or making an exit. You kind of look at your personal situation and decide what's right for you. Is your net worth in a place where you have capital that you can do the other things you want to do, or do you need that capital that's locked up in that property? I do think there's probably still, no matter what your mindset is, there's probably still a pull that you feel to grow that net worth. Everybody loves to look at their bank account and just see big numbers, right? That just makes you feel like you're just crushing it out there. And it takes a lot of self-control to pull yourself back and be like, all right, well, but that's not the goal. Unless I have plans for that money, maybe I can just keep it in the property. Maybe I just refinance out, but I keep it. Real estate is kind of a slow build game, which is why, my company is called Flywheel Equity. That's why I chose Flywheel, because it takes a lot of effort to get spinning. But once it's spinning, it maintains its motion almost on its own. Mm-hmm. So I struggle with those trade-offs a lot when I'm thinking about what the future holds. But I also know that I have to check myself and my own attitudes about building net worth versus keeping something for cash flow.
Yeah.
So I look at it. So it's the biggest disconnect between sponsor and investor, right? Mm-hmm. Sponsor gets paid by performance, by delivering a finished product. Now, yes, you could put refinance fees, and there's all types of fees you could book into a deal that you can get paid for holding it long term. But it's the biggest disconnect between the business model, right? A lot of investors want long-term cash. Now, a lot of investors want in and out, flip deals, make a lot of money. But a large part of people get into real estate is for, I know you mentioned it earlier, is the cash flow component of it. And when you're getting in and out of deals, you're discounting that. So one thing that I've been doing recently on my personal investments, where I have just, it's 3 of us that we own a building together, is we look at it from a standpoint of, okay, maybe we could put a supplemental on or refinance it. But I don't want to refinance into over leverage, because that just puts you in a shitty position in the future. God forbid something happens. You don't want to have debt is not bad, but I'm very risk adverse. So you want to refinance or refinance to moderate leverage. But the question I ask myself is, okay, if I could pull out 100 grand, 500 grand, 50 grand, whatever it is, if I reinvest that 50 grand, what am I, if I have a cash flow of 100,000, but now if I refinance, my cash flow goes to 50, but now I have an extra 500,000 to invest. Can that 500 get that 50 that I gave up? Or can that 500 be put into something that is going to be worth $1 million, right? So you have to look at it that way. But at the end of the day, I think the biggest thing that I'm looking at now is the ease of it, right? I don't want to go into a problem. I don't want to buy a problem or buy something that's going to make me, lose sleep at night, because there's something to be said about consistency. Whether am I maximizing the cash flow? Am I maximizing my net worth? It's eye of the beholder. But at the end of the day, my collections are great. My rents are good. And the property, I've already rebuilt it. I already know what I have here, as opposed to not knowing what I'm going to buy. Because even the best investors, it takes 12 months to get their, to get an understanding of what they're buying. Because you buy a complete unknown. Are the tenants going to pay? Are the tenants not going to pay? Is it need rehab through the, out the ass and all that stuff? So I think that from my standpoint, it's the level of ease that the property that I currently have, what's it doing for me as an individual? And can I go to bed at night knowing that my cash flow is there, it's consistent? If I put a little bit more debt on and I pull out some money, can I use that money for something positive to generate what I was getting, if not more? And
I think vanity and simplicity are always in tension, right? So you want that big number in the bank account. You want to be able to go do other deals. But if you've got something that's just humming along smoothly, there's so much value in that, to have a no hassle investment that's just throwing off cash. And so making sure that you're aware and acknowledging the beauty of that type of investment. And
Derek, I think, Chris, to your point, that deal that you're buying and rehabbing, I think that if it's working really well, your decision is going to be a lot different than if you're banging your head against the wall month in and month out. Month in and month out, listen, you might have doubled or tripled your money. If it's just a battle day in and day out, you will sell that property. If that property hums along beautifully, it's gonna change it, because Ryan, you're 100% right. The simplicity. Listen, everybody wants to have. Everyone wants to. Give me 1% of Amazon, right? I'll take 1% of the company and have millions and millions of dollars. But at the same time, there's nothing wrong with having $500,000 in the bank and $100,000 passive income, right? That's not. Listen, I'm not crying for that person either. It's a very nice. It's an easy lifestyle that you can put yourself in by not really reinventing the wheel. So there's something to be said about major headaches, and then there's something to be said about if the property's doing really well, right? It skews your decision a little bit.
I think one thing that we don't talk a lot about with real estate is how flexible it is. I mean, all the things we're talking about, they're questions because they're options for us as investors. Do I want to increase my net worth? Do I want cash flow? Do I want to balance? Do I want to blend? Do I want, a tax advantage way to move money around and scale up into bigger and bigger assets? Like, those are options that we have available to us as investors. So, with the stock or the stock market, it's pretty much growth and appreciation. Like, yes, there are dividend stocks, but even those are pretty paltry. Like, you really got one mode of investing. With real estate, you have options. Like, options are always a good thing as long as you understand how to evaluate them. So I think all the things we're talking about are actually still plus marks for real estate as an asset class.
Well, 100%.
John, if you can a little bit, and I don't know how personal you want to get into it, but you and your small group, you basically have gone back and forth on this battle a few times and made both decisions, starting with the 80 unit in Charleston, going into two different deals. One was a flip, one was a long-term hold. I don't know. And I know how those have turned out. So I don't know if you want to go just like, you could just a little bit more like personal, because I think you're going through it and have gone through it on, call it 3, 4, 5 deals now. I think maybe it would be a little bit helpful too.
Yeah, no. So the context behind it, we bought a property in Charleston. It was a fractured condo, 80 units. We bought 72, then bought back 80 units. And the two partners in that deal. So the structure was two individuals that invested $300,000, and then I raised $300,000. So there was 3 investors. I was on the sponsor side exclusively. And as we were getting through the property, we were raising rents from like $800 to $1,200. It was a deal that I would have owned forever, as would all of the partners, because we went into it, and the 2 partners in the deal happened to be partners in a lot of our deals. And those 2 are later stages in life. One of them is in their mid-40s. One of them is older than that. And they are both retired now, and they bought that deal as strictly a cash flow play. They were going to buy it, renovate it, refi it, and hold it forever. But we were all into the property for somewhere in and around the $68,000 a unit range. And we had brokers knocking on our door left and right. And I only got paid if the property sold or refinanced, and I would get $20,000 a year. That's really what it came out to be on a cash flow basis, which was great, right? Okay, make 20 on this property, make 20 on that property, buy 3 more of them, make $100,000. But the brokers were giving us numbers, and I never told the investors I wanted to sell, because it really wasn't my decision, right? The investors wanted the cash flow. But we inevitably ended up selling the deal for over $100,000 a unit, and the return was almost 5 times your money, 5.5 times your money in like less than 2 years. And all of those investors in the deal literally said, like, that was not our business plan at all. But we took that money, 1031'd it into 2 separate assets. One we bought as a long-term hold. It's 100 units in Wilmington, which has just performed phenomenally. And that's what I was talking about just before, about a deal that we're never going to sell. We're going to cash flow it. We're thinking about putting a supplemental on it to bring the leverage back up to around 70%. and our supplemental will actually lower our debt because our interest rates, and it's high in the 4s because we bought it a couple of years ago. And then the other, we 1031 part of it there, we 1031 part of it into a super heavy lifting flip in Jacksonville. So we took a deal that was supposed to be a long-term cash flow deal, evaluated all the options, realized that there's a ton of equity in here that you're never going to pull out, because we had, let's just call it $5 million in equity built into the property. There was not a refinance amount that would have pulled out $3 million, $4 million, because the property wouldn't have supported the debt service because it created such equity. So it wouldn't have made sense to leave that much equity in the deal that wasn't making anything. So we 1031 it. We used the options that Ryan was talking about. We bought a super heavy lifting deal to flip, and then we bought a deal for a long-term hold. And inevitably, that's where it came. We turned one deal that was $1 million investment into what now has turned into 4 properties, one long-term home, one flip. Then we've sold that flip, and we bought another property with that money. So it's been, the business plan out of the box was buy, hold, refi, never sell. And that's turned into great relationships with investors and partners. And simultaneously, the one deal cash flows that we 1030, that one deal cash flows personally with the money that I ended up rolling in as the sponsor. That deal cash flows more than the first deal was ever going to, right? The first deal would have made me 20 grand. The cash flow on the other is almost 30, 35. So and then I've parlayed that into 2 other properties that, I've been able to invest in. So it was, I want to say timing is everything, right? Yes. And we executed a business plan and it was really good. But throughout the whole time, I sat back as the sponsor. What I said earlier, my incentive was to push for sale. I get my profit and I'm happy as hell. But that wasn't the right decision for the investors. I let the investors make their own decision. At the end of the day, they all made the right decision, in my opinion. But yeah, no, we used the options and the flexibility to fit into that box. So yes, I like the peace of mind, the easy, the cash flow. I don't need a max leverage. I don't need to, go crazy. But simultaneously, we have another bucket of money that, it's all about churn it, get into a super heavy lifting deal, buy, sell, refi, so on and so forth. So you use both options, but you don't have those options in some other products. If you buy a stock and it goes up, 6 times your money, you can't just roll, you can roll it into a bunch of other stocks and gamble on it, or you could leave it all there and it takes them out. You have less options with that than you do using the right tools of a refinance, a sell, a 1031, and all that good stuff. So that's sort of a little bit more context behind why my decision was made that way, because my whole thing for real estate was very similar to Ryan, the consistency, the surety, I can see, feel, touch it, and it can produce income on a monthly basis that if I never bought a property, I can at least feed myself and live and pay the rent and pay the mortgage or whatever it is. So that's why I got into it. And yes, the net worth part of it is fun and nice, and having some money in the bank is great. But at the end of the day, if I had 10 grand in the bank, that's fine. If I was getting $200,000 a month of cash flow, if I was spending that much, that's a problem. But the cash flow was the incentive behind it. And that's where, we're even doing it now on a deal we own in Columbus, where it's, we're getting an offer this week. And the question becomes, if that offer doesn't have an $11 million number in front of it, it makes more sense to refinance it and hold because of the equity we have in the deal, the money we physically invested, and the long-term cash flow that it can produce. So if you use the tools that real estate presents, you can make these decisions fun, and that's why we do it. It's not, yes, it does a lot to the net worth, it does a lot to the cash flow, but at the end of the day, it also gives you a ton of options to analyze and underwrite and see what makes the most sense.
John, you said something really alarming. I want to dig into it. Did you just say that somebody in their 40s is in the later stage of life?
So he retired.
That all you've been thinking about while you just talked about
this whole time? I didn't hear anything else you said, John, except when you called me out and you said you're talking about somebody in the later stage of life. Then you said they're in their 40s. I was like, holy crap! What? So
that would be
there, John.
That would be alarming for sure. But no, it's in the 40s, and the other partner was a little bit older in the later stages of life.
All right, we can continue. I'm back.
Because I'm not too far away. I know I'm on the front half of the 30s, but the 40s are the new 20s, right? I feel I'm looking
it's the golden age. Yeah, absolutely.
I do want to take it in a little bit of a different direction as we're looking at time. Because Ryan, I think you've recently gone through something that a lot of people want to do at some point, which is transition from a job into real estate full time. So if you could talk a little bit about like how that decision process was like, how you looked at it, how you evaluated it, and like how you came up with a game plan to eventually get there, and then how it's kind of gone against that game plan.
Yeah, so I'm not going to act like I knew upfront how everything was going to go, and it was a super clear decision that here's the cutoff, and I go from one type of life and profession into another. It was more like I was getting to the point of being a little burned out at the job I was in. You know, startups can be a bit of a grind. 6 years for me in one place is just a massively long amount of time. And so it was more of a, all right, I know I'm ready to look at something else. What could that be? Is it another job in tech? Is it real estate I'm really enjoying on the side? Maybe I try to make the side hustle the main hustle. So it was just options, and none of them were very clear to me. So it was more that I was like, okay, I saved up some money. I have the ability to step back from everything and just take time understanding what I enjoy, what I'm motivated to do, and hopefully something will come to. And so in the process of just taking a step back from everything, real estate was already happening kind of in the background, and I just pulled it to the foreground and really started enjoying the process, right? Going out on your own to be an operator in multifamily, it was like starting a company again. And I'd started small software consultancies in the past and been an independent consultant myself. So I had that entrepreneurial streak and comfort with stepping out on your own. And so I discovered that I really enjoyed that process, starting a company again, of figuring out what it takes to build this thing and to basically be responsible for my own income, talking to investors, scouting properties, all these other things. Like I really enjoyed that sense of ownership from top to bottom. So it kind of reignited the passion I had for, getting up Monday morning, sitting down and kind of getting to work. So it was more that I created space for myself to try to find where my passion was, and in so doing, found out that real estate and what I was doing on the multifamily side was a really good fit for that. And so where I am now is that I've had some success, and I'm certainly not to the point where I'm completely living off of the cash flow of my properties, but it's starting to build. And with each acquisition, there's some acquisition fees and things that buy me more time to then create more cash flow so that I do get to a sustainable place, hopefully in short order. So that's kind of where I am now.
Gotcha. No, I think that's interesting, and it's a really good take on it. As you've gone off on your own, what is kind of been the goal for you? Is it just to get to a position where you can live? Is it to build a certain size company? Like, what is the vision for the future?
There's certainly a personal financial goal. So yes, that cash flow component and sustainable cash flow, not just living off acquisition fees forever. That's definitely one goal. I do want to make being an operator my full-time profession, at least for the near term, right? I'm not the type of person that when I talk about lifestyle freedom or time freedom, that I want to go live on a beach somewhere. Mm-hmm. I'm most enjoying life when I'm kind of intellectually challenged and learning new things. So the goal is establish sustainable cash flow so that I can live comfortably, continue to grow Flywheel Equity as a business. And the goal with Flywheel Equity is not to be have X number of people employed, and like that doesn't motivate me. In fact, one of the things that I like most about this style of real estate, again, we talked about flexibility in the asset class, but in the ownership structure, there's flexibility. Every deal you do, you can be working with a different set of partners, whether they're investors, co-operators, and so identifying a property and pulling in the people that are necessary to make that property acquisition happen, that's a big benefit to me. I don't like being locked into just one set of structures or one set of people. That there's a lot of enjoyment I get from working with different groups. And I really like that flexibility. And there's no employer-employee relationship. You're all kind of partners working together. And I really like that. I was one of the things I was burnt out with in my last role was having moved into management and leadership. You become just a manager of people just all the time. Every little thing that people need and have issues with, like it all floats up to you. And so you just feel like you're firefighting all the time. And that was getting to be pretty exhausting. It's very rewarding to support people, but it can also be exhausting. And so I really like having more of a partnership structure than an employer-employee structure for the people that I work with. So it's not to say that going forward, maybe one or two people formally become part of the company and help out in some way. But I really want to keep that group very small and really lean into the benefits of having that flexibility that it provides.
I think that's one of the really great things about being an operator, syndicator, real estate investment company. There's so many multi-$100 million companies out there that are not super large. They're not a staff of 100 people. They're a staff of anywhere from, 3, 4 to 10, and you don't have to have this massive company to build, a sizable business and really create, a nice value for yourself. And I think one of the benefits too for the people that work there is they can take what they're doing at work and directly apply it to their own stuff. They can go out, instead of buying a 200 unit property, they can go out and buy a 20 unit or a 10 unit or a duplex and do the same thing. It's really tough to do that in other ways. And we spoke a lot about that with Chris Ford, is a young guy working at an investment company in, I think it's San Francisco. I think there's just a lot of different ways that, like you said, you can structure it to really build something nice without having to, generate massive revenues to build up a nice company. You just don't have, it doesn't feel like you need as much overhead to build something good and nice and sustainable for yourself.
Yeah. So you guys don't talk much about yourselves at Toro. What is your structure as far as employees, contractors, vendors? Like how many people are officially a part of Toro versus people that you work with or on a contract basis? Is that something you're comfortable sharing?
Yeah, no, 100%. We have 4 full-time people. It's myself, my partner, Chris, and Lauren. We don't pay anybody, but they work for us full time. No. There's 4 of us. The Toro office is 4 people on a daily basis. We do have some other people doing some acquisitions, and we have, part-time people coming in, cold calling. And one thing that I think I've liked, at least I want to create, not like, I want to, even like Chris, when he came, he's brought some ideas to me. He's like, do you mind if I do this? No, of course not. It's not about generating max dollars for Toro, because the purpose of what we're doing is, Toro buys larger multifamily properties where we syndicate, 70 to 80% of the equity, and we contribute. Chris has a ton of money invested in our deals from a straight investment. So does, people that Chris knows. But the internal, how many more people do, maybe we could probably bring in a more financially savvy, CFO type role. Other than that, our legal's outsourced, our accounting's outsourced. And then the acquisitions are, internal, and the raising the money is internal. We all take part in a lot of those roles. And it's something we're trying to figure out, a better way to go about day-to-day operations, to get better at asset management, to get better at acquisitions, to get better at investor relations. But there's 4 of us. There's 4 of us in the office. And, we do, this year we only bought 2 properties, about $20 million total on the multifamily side. We're going to close on a mobile home park, but it's only $1 million. So we're not, a company that's buying $20 million worth of real estate, raising about, let's call it $8 million in equity for those deals. There's 4 of us, right? And we've had years where we've done significantly more. This is probably our worst acquisition year, because of Corona, and we were maybe a little conservative when others were a little bit more aggressive. But there's only 4 of us, and I don't think, I always said, I tell people all the time, really young people that ask me questions, how'd you start? Listen, when I started, I wanted a $1 billion investment company, and I can't say I don't want that anymore, but I would much rather a more efficient $1 million company that is just efficient and generating money with less headaches than $1 billion company with 80 employees. Because Ryan, you're 100% right. Part of being in a role where you have people working for you, you become a shrink, right? You just deal with so many emotions, and okay, you didn't do this right, or you didn't do that right. And I have no desire. I'm starting to weed out investors by basically, when they start asking stupid questions, I'm just not allowing them to invest anymore, because I have no desire to add a layer of pressure when I don't have to, right? Because we have really good investors that sit back, relax, and let us do our thing. We have guys that ask a lot of questions, which is fine, and there's nothing wrong with that. But then there's other people that, are texting me on a daily basis, what's the occupancy? And I'm like, nothing has changed, right? It's the same as it was yesterday. So we're trying to get better, but there's 4 of us. There's 4 full-time people. Mm-hmm. We're not, 3 full-time and 1 part-time. So it's not a 30-person company, right? We sort of just go with the flow. It's very startup-esque. I mean, we had a bookkeeper come in the other day with a suit on, and my partner Don's like, a suit? Like, we were, it's a t-shirt and jeans. It's not a very structured, 80-person major company, right? We could do a little bit better on structure for sure, but that's it. There's 4 of us. And I think, we're pretty good at what we do. I don't think we're the best. I think anyone can get better, but, for the most part, that's about it.
Yeah. So how many units do you have under management right now?
Right now, we're about 2,700.
So almost 3,000 units under management for 4 people, right? So there's a level of scale that can be accomplished in this business. And, we talked before about tensions and not letting vanity get in your way. Like, I think it's the same thing around building a company. I'm sure your mom would be really proud if you, built a 20-person company that was still growing, but you don't need to. And there's a lot of overhead that comes with it. So I think it's pretty cool that you can own 3,000 units and however many hundreds of millions of dollars of assets under management that represents, and there be, 4 people at the end of that path.
And to your point earlier, we have every deal we can structure. Like, we have a couple deals where we have 2 other co-GPs that, put a large chunk of equity in, and they take a lot of responsibility off our shoulders. I mean, some of our best run asset management deals are not the deals that we're doing the asset manage on. Now, I was talking about this yesterday. I love when there's a problem, someone calls me and says, how do we fix this? I love that. Do I love going, before we started recording this, we were going through a general ledger and accounts payable. And I'm like, fuck, I can't figure what the hell. Like, it's not the part of the business that I like. And I know that, and I admit that. And that's why we have people around us that can take care of that stuff. But to your point, we have flexible structures with people, and where people take on a different role. And some of our investors are our best co-GP partners. So, and that's something you can do. Like you said, it's impressive if you're growing a company that's growing and hiring and all that stuff. But, we have just about 3,000 units. We made a major shift. We brought our manager from Columbus down to Jacksonville. We actually got rid of our Jacksonville site, our management team. So now we have basically 1 management company we're working with, and it's going to make us so much more efficient. 1 set of reports, 1 point of communication. So it was a very hard decision, because she was one of our best managers. She was phenomenal for the last 7 years or 6 years, but they are looking to grow. And now I have more confidence in going into some of the secondary and tertiary areas that I wouldn't have. But it was what we needed to grow more efficiently, as opposed to, the 2 separate people and speaking to this accountant and that accountant. So there's ways that you can work as a company with 4 people, get to 3,000 units. And there are things you can do with your third-party management or with your accounting where you can take a lot of the pressure off yourself. And it's not always about, we have to hire an accountant, we have to hire another acquisition guy for the Southeast. You don't have to do that. So you can be really flexible with your structure, and you could put together 3,000 units and do a pretty good job, right? I always think you could do better, but that's how we're structured. And that listen, I know people that have 400 units and have 10 employees, right? So it's just a matter of what makes most sense for you and how much work you're willing to take on and how much, you want to put yourself through.
Yep. No, that makes sense. Yeah. I'm kind of in the opposite stage, right? So I'm in the stage where I want to know that every task, every role is something that I at least have enough knowledge that I could do it myself. So from tip to tail, from acquisitions, from investor relations, from financing, from closing, from from managing property managers, like and operations and asset management and financial reconciliation, like I'm doing all that right now. because my portfolio is small enough, because I'm in the stage where I want to gain that experience so that when I do hire somebody or work with somebody else, I can hold them accountable. And I know it's going to be to my quality. And if they're not accountable or they need to exit, I can at least step in temporarily. So, and I feel like you need that stage before you can get to the scale stage. And so that's just my approach right now.
No, and that I tell people, I have a ton, this whole world, right? This, these 18, 20-year-olds, even 30-year-olds and 40-year-olds today, they step into businesses and they want the done for you button. They just want to push a button and have everything done. Where if you don't go through the process of cold calling for deals, if you don't go through the process of looking at your financials, and then you hire someone to do it, you have no idea if they're doing a good job or a bad job because you've never done it. And I know that you can hire really good people out of the box that can figure it out and you never have to look at it. I don't think I could sleep with myself if I haven't gone through it at least once to know there's a mistake being made or not. Because if you hire the wrong person,
everybody needs accountability. I don't care how good you are, you need to know that somebody is holding you accountable. If you're the CEO, you've got a board. If you're a low-level engineer, you've got a manager. And if you're an accounting consultant or vendor coming in, the CEO or the CFO is looking over your shoulder. The system works better when there's our systems of accountability in place.
Absolutely. So that's super important for anyone starting. Listen, you can go out and you can go buy, 5,000 units tomorrow and hire a full staff. There's nothing wrong with that. I just feel that, getting a little dirty into the weeds on things and then, even if it's someone, hey, I'm going to talk to someone once a week with my goals, right? Just making sure you're moving down, moving the ball down the field to get to that goal, whatever that goal is. Everyone needs it. It's something we absolutely have to do better internally. But be that as it may, I agree with that 100% because once you know everything, it's a lot easier to find the person to sit in that seat that can do it the way you want it done, as opposed to not knowing that.
Yeah, and one of the things I've taken from my time in tech is the value of transparency. All right, so we talked about accountability. One of the best ways to establish that is through transparency. And so a lot of what I do now with my investors is make sure that whether it's financials, whether it's the property management status, rehab status, I am making all of that information available in a way that everybody can access. And it's not that every investor cares about that stuff or wants to know it, but the fact that it's there, that it even affects how I operate, right? If I know that everything that I'm doing is going to be available to everybody else, that is like implicit accountability for myself. I'm going to be thinking with their requirements in mind and their concerns in mind. And so it just makes me a better operator operating that way.
Yeah, I remember, John, we were talking about on another episode about whether you should pay for coaching or is mentorship the right thing. And you said, even if the mentor is the worst and you basically throw $10,000 in the garbage, there's a good shot it's going to be the catalyst that's going to keep you moving forward. So if you paid $10,000 for flipping, well, you're out 10 grand. So if they suck, you're going to want to make the most of the 10 grand you spent. So there's a way greater chance that you're going to try to figure it out and make it work than if you just tried to do it on your own. Basically, you're accountable to the money you spent, what you said you were going to do, the business plan you put together, and potentially even the coach, even if they're the worst thing in the world. I mean, myself, my mom and cousin bought the flipping course. I have no idea if I would be sitting here today if we had just decided to try flipping, because we failed. We never flipped a home, but I would be.
Oh, no, we did. We lost a ton of money on the one deal.
Well, that was years later. That was after I knew you for a couple of years and you suckered us into a loser. But it was more of I think back now and I'm like, okay, if we hadn't done that and we just said, all right, we're going to try to flip. And then 4 months in and we just didn't do anything, we might have just hung up our boots and called it a day and said, it wasn't right for us. There's probably a really strong chance that because we spent a ton of money on a course that we said, fuck it, we're going to go out, we're going to make this work, we're going to network with people, we're going to try to figure this out another way, because we were basically accountable to ourselves and the investment we had made. So I just think, there's a ton of different ways to be accountable to yourself. And I think it's just going to push people a lot farther. So just as you were talking, it reminded me of that. And I thought it was interesting.
Accountability is key.
100%. I think that's an awesome place to wrap up. Ryan, thank you so much for coming on. I think this is a really awesome episode. I think people are going to get a ton of value out of it. If people want to get in touch with you, follow you, learn more about you, where can they do all that?
Yeah, I'm on Instagram, LinkedIn, all the typical places. I think the central source of information is on my website, flywheeleq.com, EQ short for equity, flywheeleq.com. Got a lot of information there about the current portfolio. And if you're a passive investor or an active investor, investor is kind of an overloaded term these days. If you're a passive investor, you call yourself an investor, and yet we call ourselves investors too, being on the active side. And obviously those are two very different jobs, but I've got some good resources there for passive investors looking to get into real estate to understand it better as an asset class, and even go one step further and kind of look at maybe some statistics around which metros and which areas are really strong for multifamily. So that's on my website. And then if you're an active investor too, or just kind of getting started, want to talk about underwriting, I've got some resources there. So it's really the best place is the website.
Awesome. Guys, definitely go check it out. Ryan's a great guy to connect with and learn from, so be sure to do that. Thank you all so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that you think would get a tremendous amount of value from this episode with Ryan. Ryan, once again, thanks for coming on. This was great, bud.